Hey everyone, and welcome to the channel. Today we're diving deep into VPU, an exchange-traded fund that tracks the utilities sector. You might be wondering if VPU could be a secret weapon for your portfolio, especially when it comes to income generation. But is VPU really all it's cracked up to be? We'll be uncovering its strengths and weaknesses, like its low expense ratio and potential for regular dividend payouts. But we'll also compare it to other income options and see if it truly stands out. So, stick around to find out if VPU is a friend or foe for your portfolio, and how it can fit into your overall investment strategy. We'll break down everything you need to know about VPU in the next few minutes. What is Vanguard Utilities Index Fund ETF VPU? Vanguard Utilities Index Fund ETF VPU is an exchange-traded fund, ETF, designed to track the performance of the utilities sector in the United States stock market. Here's a breakdown of what VPU is and how it functions. Investment objective. VPU seeks to mirror the performance of a specific benchmark index, typically the MSCI US Investable Market Utilities 2550 Index. This index includes stocks of various U.S. companies within the utilities sector, encompassing electric, gas, and water utility companies, along with independent power producers and distributors. Investment strategy. VPU employs a passive management strategy, meaning it doesn't actively pick and choose individual stocks. Instead, it aims to replicate the holdings and weighting of the underlying index. This approach offers several advantages. Lower expense ratios. Passively managed funds like VPU generally have lower fees compared to actively managed funds due to the lack of a research team and portfolio management activities. Broader market exposure. VPU provides instant diversification across the utilities sector, reducing concentration risk compared to holding individual utility stocks. Market efficiency. The passive approach assumes the market is semi-strong or strong, meaning all available information is already reflected in stock prices. Structure and holdings. VPU holds a basket of U.S. utility stocks in proportion to their weighting in the target index. This weighting can be based on market capitalization, larger companies have a bigger influence, or other factors defined by the index methodology. The expense ratio of VPU is typically low compared to actively managed funds, typically around 0.08% or less. This fee covers the operational costs of running the ETF. VPU trades on a stock exchange, NYSERDA, like individual stocks, offering investors liquidity to buy and sell shares throughout the trading day. Distributions. VPU typically distributes dividends earned from the underlying stocks on a quarterly basis. This can be a source of income for investors seeking regular payouts. Benefits of investing in VPU. Diversification. VPU provides exposure to a broad range of utilities companies, mitigating the risk associated with any single company's performance. Income generation. Utilities are known for their relatively stable dividends, making VPU an attractive option for income-oriented investors. Lower costs. The passive management approach of VPU translates to lower fees compared to actively managed funds. Liquidity. VPU trades on a stock exchange, offering investors easy entry and exit points. Considerations before investing in VPU. Sector concentration. VPU focuses solely on the utilities sector, which can be susceptible to interest rate fluctuations and regulatory changes. Diversification across different sectors might be necessary. Market volatility. While utilities are generally considered less volatile than the overall market, they are still subject to market downturns. Limited growth potential. Utilities are known for steady dividends but might not offer the same growth potential as companies in other sectors. When was VPU launched, and what was the rationale behind its creation? Vanguard Utilities Index Fund ETF, VPU, was launched on January 26, 2004. The rationale behind its creation centered on several key factors. Growing demand for broad market exposure. In the early 2000s, the popularity of index investing was on the rise. Investors increasingly recognized the benefits of diversification and lower costs associated with passively managed funds that track broad market segments. VPU offered a convenient way to gain exposure to the entire U.S. utilities sector, eliminating the need for individual stock selection and research. Utilities sector appeal. The utilities sector has historically been viewed as a relatively stable and defensive investment. Utility companies provide essential services like electricity, gas, and water, experiencing consistent demand regardless of economic conditions. This stability made VPU an attractive option for investors seeking income generation and portfolio diversification, particularly those nearing retirement or with a more conservative risk tolerance. Vanguard's focus on low-cost investing. Vanguard, the issuer of VPU, is a leader in the low-cost investment movement. By offering an ETF that tracks the utilities sector with a low expense ratio, VPU made this asset class accessible to a wider range of investors. Lower fees translate to a higher return for investors, making VPU a compelling proposition compared to actively managed funds with higher fees. Does VPU track a specific index? If so, which one and what is its methodology? Yes, VPU tracks a specific index, the MSCI US Investable Market Utilities 2550 Index. This index serves as the benchmark for VPU's holdings and performance. Here's a breakdown of the index and its methodology. Index selection, MSCI US Investable Market Utilities 2550 Index. MSCI, Morgan Stanley Capital International, is a leading provider of investment research, stock market indexes, and other financial services. The U.S. investable market portion of the index name refers to the universe of stocks considered for inclusion. This typically includes all large, mid, and some small-cap stocks listed on U.S. exchanges and meeting specific liquidity and investability criteria. Utilities specifies the sector focus of the index, concentrating on companies within the utilities industry. Index methodology, 2550 approach. The 2550 designation in the index name refers to the weighting methodology used to determine the relative importance of each stock within the index. Here's how it works. Market capitalization weighting. This is the primary factor influencing a stock's weight in the index. Companies with a larger market capitalization, total market value of outstanding shares, have a greater influence on the index performance. Free float adjustment. Not all shares of a company are freely available for trading. The 2550th refers to the inclusion of only the freely tradable shares, free float, when calculating market capitalization for weighting purposes. This ensures the index reflects the investable universe for most investors. Additional considerations. The index is rebalanced periodically, typically quarterly, to ensure the weights of individual stocks remain aligned with their respective free float adjusted market capitalizations. The index may also have specific eligibility criteria for companies to be included, such as minimum profitability or listing requirements. Impact on VPU. By tracking the MSCI US Investable Market Utilities 2550 Index, VPU aims to replicate the performance of the broader U.S. utilities sector. The weighting methodology ensures that larger, more liquid utility companies have a greater influence on the overall performance of VPU. This approach provides broad exposure to the sector while potentially mitigating some of the risks associated with smaller, less established companies. How has the performance of VPU compared to its benchmark index historically? Here's a breakdown of how VPU's performance has compared to its benchmark index historically. Generally tracking performance. VPU, by design, aims to mirror the performance of the MSCI US Investable Market Utilities 25/50 Index. Over longer timeframes, VPU's returns should be very close to the index, with potential minor deviations due to factors like tracking differences and expenses. Tracking differences. As mentioned earlier, VPU might incur small transaction costs when buying or selling underlying holdings to align with the index. These costs can eat slightly into the returns compared to the pure index performance. Additionally, depending on how the ETF is held, e.g., in a taxable account, capital gains distributions from VPU can create tax implications for investors. These taxes can further cause a slight divergence between VPU's returns and the index. What is VPU's investment objective? Vanguard Utilities Index Fund ETF, VPU, has two primary investment objectives. 1. Track the performance of the U.S. utilities sector. VPU is designed to replicate the performance of a specific benchmark index, typically the MSCI US Investable Market Utilities 25/50 Index. This index represents the broad U.S. utilities sector, encompassing companies that provide essential services like electricity, gas, and water. By holding a basket of these utility stocks in proportion to their weighting in the index, VPU aims to deliver returns that closely mirror the overall performance of the sector. 2. Provide income generation. Utility companies are known for their relatively stable dividend payouts. These dividends represent a portion of the company's profits distributed to shareholders. VPU, by holding dividend-paying utility stocks, inherits this income stream. The ETF typically distributes these dividends to its shareholders on a quarterly basis. This can be a valuable source of income for investors seeking regular payouts. Here's a breakdown of how these objectives work together. VPU prioritizes broad sector exposure by tracking a diversified utilities index. This reduces concentration risk compared to holding individual utility stocks. The focus on the utilities sector caters to investors seeking income generation, as utility companies generally offer more consistent dividends compared to companies in other sectors. Does VPU employ any specific strategies to achieve its objectives? VPU, as a passively managed ETF, doesn't employ complex investment strategies to achieve its objectives. Instead, it relies on a straightforward approach centered around mimicking the benchmark index. 1. Index replication strategy. The core strategy of VPU involves replicating the holdings and weighting of the target index, typically the MSCI US Investable Market Utilities 25/50 Index. This means VPU holds a basket of US utility stocks in proportion to their representation in the index. Larger, more established utility companies with higher market capitalizations will have a greater weight within VPU's portfolio, reflecting their influence on the overall sector performance. 2. Full replication versus sampling. Ideally, VPU strives for full replication, where it holds all the stocks in the underlying index and in the exact same proportions. This ensures the closest possible tracking of the index performance. However, in some cases, regulatory restrictions or practical limitations might prevent VPU from holding every single stock in the index. In such scenarios, VPU may employ a sampling strategy. Sampling involves holding a representative selection of stocks from the index, aiming to capture the overall performance characteristics while potentially introducing minor tracking differences. 3. Rebalancing. To maintain alignment with the target index, VPU rebalances its portfolio periodically, typically quarterly. This involves buying or selling underlying stocks to ensure their weights within VPU remain consistent with their representation in the index. Rebalancing helps VPU stay on track with its objective of mirroring the sector performance as defined by the benchmark index. Benefits of this approach: lower costs. Passive management eliminates the need for a research team and active stock selection, translating to lower expense ratios for VPU compared to actively managed funds. Diversification. VPU offers broad exposure to the U.S. utilities sector, reducing concentration risk compared to holding individual utility stocks. Transparency. The holdings and weighting of VPU are publicly available, allowing investors to understand the underlying composition of the ETF. Limitations of this approach: tracking error. As mentioned earlier, VPU might not perfectly replicate the index due to tracking differences, transaction costs, and potential sampling deviations. Limited alpha potential. Passive management doesn't aim to outperform the market, it seeks to match the index performance. Investors seeking alpha, excess return over the market, might need to look beyond VPU. How often does VPU rebalance its holdings? Vanguard Utilities Index Fund ETF, VPU, typically rebalances its holdings on a quarterly basis. This means the fund reviews its portfolio composition every 3 months to ensure it aligns with the target index, usually the MSCI US Investable Market Utilities 2550 Index. Here's a deeper explanation of the rebalancing process in VPU. Maintaining index alignment. Over time, natural market fluctuations can cause the market capitalizations, total market value, of underlying holdings in VPU to change. This can lead to a situation where the weights of individual stocks within VPU deviate from their representation in the target index. Rebalancing addresses this issue by strategically buying or selling holdings. VPU might buy more shares of stocks whose weight has fallen in VPU relative to the index. Sell shares of stocks whose weight has become disproportionately high within VPU compared to the index. Benefits of quarterly rebalancing. Reduced tracking error. Regular rebalancing helps VPU maintain a close alignment with the target index, minimizing the deviation between VPU's performance and the index performance, known as tracking error. Maintaining sector exposure. Rebalancing ensures VPU's portfolio reflects the current composition of the utilities sector as defined by the index. This helps VPU stay true to its objective of providing exposure to the sector's performance. What are the primary risks associated with investing in VPU? Investing in VPU, like any investment, carries inherent risks. Here's a breakdown of the primary risks associated with VPU. Sector concentration risk. VPU focuses solely on the U.S. utilities sector. This means its performance is heavily tied to the fortunes of this specific industry. If the utilities sector experiences a downturn due to factors like regulatory changes, technological advancements, or economic conditions, VPU's returns can suffer significantly. Diversification across different sectors can help mitigate this risk. Interest rate risk. Utility companies are often sensitive to interest rate fluctuations. When interest rates rise, the value of future dividend streams from utilities, which are typically fixed, becomes less attractive to investors, potentially leading to a decline in utility stock prices. VPU, being heavily invested in utilities, is susceptible to this risk. Investors seeking interest rate sensitivity might consider alternative sectors. Market volatility. While utilities are generally considered less volatile than the overall market, they are not immune to market downturns. Economic recessions or broader market corrections can still impact the performance of utility stocks, leading to a decline in VPU's share price. Investors with a lower risk tolerance might consider incorporating more defensive assets or asset allocation strategies. Tracking error. As discussed previously, VPU might not perfectly replicate the target index due to tracking differences like transaction costs and potential sampling strategies. This tracking error can lead to VPU's returns deviating slightly from the index performance over time. Liquidity risk. While VPU is generally considered a liquid ETF due to its exchange-traded nature, there's a possibility of lower trading volume in less volatile periods. This could lead to slightly wider bid-ask spreads, difference between the buying and selling price, when an investor wants to enter or exit the position. How has VPU performed during market downturns? VPU's performance during market downturns can be a mixed bag, depending on the severity and nature of the downturn. Here's a breakdown of how VPU might behave. Potential benefits. Relative stability. Utilities are often viewed as defensive investments because they provide essential services like electricity, gas, and water. Demand for these services remains relatively steady even during economic slowdowns. This can translate to VPU's share price experiencing less volatility compared to the broader market during downturns. Dividend income. Utility companies are known for their consistent dividend payouts. Even during recessions, utility companies may prioritize maintaining dividend payments to attract investors seeking income. This can provide a source of income for VPU shareholders even if the share price declines. Potential drawbacks. Interest rate sensitivity. As discussed earlier, rising interest rates can negatively impact the value of utility stocks. This is because the fixed dividends offered by utilities become less attractive compared to higher-yielding bonds or other interest-bearing investments. Sector concentration risk. If the downturn disproportionately affects the utilities sector due to specific industry challenges or regulatory changes, VPU's performance can suffer significantly. This highlights the risk of sector concentration. What is the expense ratio of VPU? The expense ratio of VPU, Vanguard Utilities Index Fund ETF, is typically around 0.08% or less. This is a very low fee compared to actively managed funds. Here's a breakdown of what expense ratios are and how they impact VPU. Expense ratio explained. The expense ratio is an annual fee charged by the fund to cover its operational costs, including administration, marketing, and any underlying index licensing fees. This fee is expressed as a percentage of the fund's assets under management, AUM. Low expense ratio of VPU. VPU, being a passively managed ETF, benefits from lower operational costs compared to actively managed funds that require research teams and portfolio management activities. This translates to a low expense ratio, typically around 0.08% or even lower. This means for every $10,000 invested in VPU, the annual expense would be around $8 or less. Impact on investors. A lower expense ratio translates to a higher potential return for investors. This is because a smaller portion of the fund's assets are used to cover operational costs, leaving more available for potential growth and dividend distribution. VPU's low expense ratio makes it an attractive option for investors seeking cost-effective exposure to the U.S. utilities sector. What is the underlying distribution schedule for VPU? Vanguard Utilities Index Fund ETF, VPU, typically distributes dividends on a quarterly basis. This means that investors holding VPU can expect to receive dividend payouts 4 times a year. Here's a deeper explanation of VPU's distribution schedule. Source of dividends. VPU holds a basket of U.S. utility companies known for their consistent dividend payouts. These companies distribute a portion of their profits to shareholders, including VPU, as dividends. VPU, in turn, distributes these received dividends to its own shareholders, following the underlying distribution schedule. Quarterly distribution. VPU usually follows a quarterly distribution schedule. This means that the fund accumulates the dividends received from its underlying holdings throughout the quarter. At a predetermined date within the quarter, typically announced in advance by Vanguard, VPU distributes these accumulated dividends to its shareholders. What is the current sector allocation of VPU? VPU sector allocation is almost entirely focused on the utilities sector. Here's a breakdown of what you can expect. Dominant utilities allocation. VPU strives to track the performance of the MSCI US Investable Market Utilities 25/50th Index, or a similar benchmark. This index represents the U.S. utilities sector, encompassing companies that provide essential services like electricity, gas, and water. Due to this focus on the utilities sector, VPU's portfolio allocation will overwhelmingly be in utility stocks. You can expect around 98% or more of the fund's assets to be invested in this sector. Minimal allocation to other sectors. In some rare instances, VPU's holdings might include a minimal allocation, less than 2%, to other sectors due to a few reasons. Index composition. The target index, MSCI US Investable Market Utilities 25/50th Index, might have a minuscule allocation to other sectors besides utilities due to the classification methodology. For example, a company with a diversified business model might be categorized under utilities but have a small portion of its revenue coming from a non-utility sector. When VPU tracks this index, it inherits this minimal non-utility allocation. Cash holdings. VPU might hold a small amount of cash, typically less than 1%, to manage daily operations and facilitate transactions. This cash allocation wouldn't be considered a sector, but rather a temporary holding. What is the liquidity of VPU? Vanguard Utilities Index Fund ETF, VPU, is generally considered a highly liquid investment. Here's a breakdown of what liquidity means for VPU and how it benefits investors. Trading on a stock exchange. Unlike mutual funds that can only be bought or sold at the end of the trading day, VPU trades on a stock exchange, NYSERDA, like individual stocks. This allows investors to buy and sell shares of VPU throughout the trading day. High trading volume. VPU is a popular ETF with a large number of investors holding shares. This translates to a high daily trading volume, meaning a significant number of shares are bought and sold each day. Tight bid-ask spreads. The bid-ask spread represents the difference between the highest price a buyer is willing to pay for a share, bid, and the lowest price a seller is willing to accept, ask. Due to VPU's liquidity, the bid-ask spread is typically tight, meaning investors can enter or exit positions at prices close to the current market value. Benefits of liquidity. High liquidity allows investors to easily buy and sell VPU shares as needed. This flexibility is crucial for investors who might need to adjust their portfolio allocation or exit the investment quickly. Tight bid-ask spreads minimize the transaction costs associated with buying or selling VPU shares. This allows investors to capture a larger portion of the ETF's returns. Potential impact on liquidity. While VPU is generally liquid, there's a possibility of slightly lower trading volume during less volatile market periods. This could lead to marginally wider bid-ask spreads, although it wouldn't significantly impact liquidity. How do the expense ratios and holdings of VPU compare to other utilities ETFs? Here's a detailed comparison of expense ratios and holdings between VPU and other popular utilities ETFs. Expense ratio comparison. VPU. As discussed earlier, VPU boasts a very competitive expense ratio, typically around 0.08% or even lower. This makes it one of the most cost-effective options for investors seeking utilities sector exposure. Alternatives. Here's a look at some other utilities ETFs and their expense ratios. FUDI, Fidelity MSCI Utilities Index ETF, expense ratio around 0.08%, similar to VPU. XLU, Utilities Select Sector SPDR Fund expense ratio around 0.1%, slightly higher than VPU. IDU, iShares US Utilities ETF, expense ratio around 0.4%, significantly higher than VPU and FUDI. RSPU, SPDR SP Utilities ETF, expense ratio around 0.4%, similar to IDU. Overall, VPU and FUDI stand out for their exceptionally low expense ratios. Investors seeking the most cost-effective way to access the utilities sector might favor these options. Holdings comparison. Benchmark index. Most utilities ETFs, including VPU, track a similar benchmark index, often the MSCI US Investable Market Utilities 2550 Index or a variant. This leads to a significant overlap in holdings. Number of holdings. However, there can be differences in the number of holdings within each ETF. VPU tends to hold a larger number of individual utility stocks compared to some competitors. VPU typically holds several hundred utility stocks. XLU holds around 70 utility stocks. Benefits of more holdings. A larger number of holdings in VPU can potentially enhance diversification within the utilities sector, reducing concentration risk compared to ETFs with fewer holdings. However, it's important to note that the overall sector allocation remains heavily concentrated in utilities for all these ETFs. Other factors to consider. Underlying index. While the benchmark index might be similar, there could be slight variations in the specific index each ETF tracks. This can lead to minor differences in holdings and performance. Trading volume and liquidity. While all these ETFs are generally liquid, VPU and XLU tend to have higher daily trading volumes compared to IDU and RSPU. This can translate to tighter bid-ask spreads for VPU and XLU. How would VPU fit within a broader portfolio allocation strategy? VPU can potentially play a role in a broader portfolio allocation strategy, but it's crucial to understand how it fits within the overall picture. Here's a breakdown of VPU's potential role and considerations for portfolio allocation. Potential benefits. Income generation. VPU, through its holdings of dividend-paying utility stocks, can provide a source of regular income for investors. This can be particularly attractive for retirees or income-oriented investors. Diversification. Within limits, VPU offers exposure to a different sector, utilities, compared to stocks or bonds. This can help diversify a portfolio and potentially reduce overall portfolio volatility. However, remember, VPU remains concentrated within the utilities sector itself. Hedge against inflation. To an extent, utility companies often have pricing power, allowing them to raise prices moderately to keep pace with inflation. This can offer some protection against inflation's erosive effects on purchasing power. Considerations for portfolio allocation. Risk tolerance. VPU's performance is heavily tied to the utilities sector. Investors with a lower risk tolerance might want to limit their allocation to VPU and focus on more defensive assets like bonds. Investment goals. If your primary goal is capital appreciation, VPU might not be the most suitable option. Historically, the utilities sector's growth potential can be lower compared to other sectors like technology or consumer discretionary. Overall asset allocation. VPU should ideally be a part of a diversified portfolio with various asset classes, stocks, bonds, cash equivalents, to manage risk and target your return objectives. Here are some allocation strategies incorporating VPU. Income-oriented portfolio. For retirees or income-seeking investors, a small to moderate allocation, 10 to 20%, to VPU can be considered alongside dividend-paying stocks and bonds. Balanced portfolio. In a balanced portfolio aiming for moderate growth and income, a smaller allocation, 5 to 10%, to VPU can be included with domestic and international stocks, bonds, and cash. Growth-oriented portfolio. For investors with a higher risk tolerance and a focus on long-term capital appreciation, VPU might play a minimal role, less than 5%, or even be excluded altogether, with a focus on growth stocks across different sectors. How does the dividend yield of VPU compare to other income-generating investments? VPU's dividend yield can be compared to various income-generating investments, but it's important to understand the strengths and weaknesses of each option. Here's a breakdown. VPU's dividend yield. VPU's dividend yield typically falls within the range of 3% to 4%. This yield can fluctuate depending on the current market environment and the dividends paid by its underlying utility stocks. Comparison with other options. High dividend stocks. Some individual stocks, particularly those in sectors like consumer staples or telecommunications, may offer higher dividend yields than VPU. However, these individual stocks carry higher concentration risk compared to VPU's diversified basket of utilities. Dividend-paying ETFs. There are other dividend-paying ETFs focused on different sectors or strategies. Some might offer slightly higher yields than VPU, but it depends on the specific ETF's holdings. For example, an ETF focused on real estate investment trusts, REITs, might have a higher yield, but also carry different risk characteristics. Corporate bonds. Investment-grade corporate bonds can offer yields similar to or slightly lower than VPU. However, bonds generally have lower volatility than VPU, making them a more defensive income option. However, bonds are also susceptible to interest rate risk, which can negatively impact their price. High-yield bonds. These bonds offer significantly higher yields than VPU, but they also carry a much higher risk of default. They should be approached cautiously and might not be suitable for all investors. Alright, folks, that brings us to the end of our deep dive into VPU. We explored its potential as an income source, its place within a diversified portfolio, and how it compares to other options. Remember, VPU can be a valuable tool, but it's not a one-size-fits-all solution. Consider your risk tolerance, investment goals, and overall asset allocation before making any decisions. If you're looking for more income-focused content, or want to explore different sectors and asset classes, leave a comment below and let me know what interests you. Don't forget to like this video and subscribe to the channel for more investment breakdowns and strategies. Thanks for watching.